Welcome to another episode of Corporate CPR, where we breathe life back into your organization, projects, and processes, giving you insights to recovery and avoiding corporate mortality events. Today, we'll be talking about how to improve your success in business, and joining us to contribute to the conversation is Scott Paterson. Scott, I'm so excited to have you here today. Thank you for joining.
My pleasure, Jana.
I'd love for you to take a minute and provide a little bit of a background.
Well, I budgeted about an hour for my background. Hopefully you and your listeners are all set. You know what? I'm really lucky. I've had a heck of a fun time in my vocational life thus far. But I think the best way to describe my world is that I am a technology-focused entrepreneur as it relates to either media or financial services. I spent half my career in the kind of formal part of the investment business, actually starting as a stockbroker way back when, cold calling people, and did quite well at that. And most people hate cold calling. I loved it then, and I sort of still like it now. It's kind of a cool and sometimes bold thing to do. And then I went into investment banking, raising money for companies. And then I built what became the most successful technology investment bank in Canada many moons ago. And so that was kind of the formal part of my career. And then I moved to really venture capital, where I love entrepreneurs, again, mostly in those two sectors, media and financial services. And people pitch me all day long. I invest in lots of different things. But from time to time, I get really behind a project. I typically become chairman, put my own money to work, bring in a syndicate of investors that I work with, and off we go. One other thing, just, I got a little bit lucky, as we all can use luck in our careers and lives. But one of my former business partners back in 1997 founded Lionsgate Entertainment, which maybe not everybody knows the company, but they've certainly seen our movies and our TV shows. And he was the first investor as the founder, and I was the second investor in the company, and served on the company's board for 21 years. And I'm still involved on some subsidiary boards. And that's what really kind of gave me an opportunity to rub shoulders with some extremely interesting, fascinating, successful people in Hollywood and Los Angeles, and really how I cut my teeth in the media world. So that kind of explains the media part, and the background in the financial services explains that part of my background.
Well, but it sounds like with all your investing, then you've got a real good eye, though, for what makes a company successful, which goes great for today's conversation. And I just have to say, you talked about cold calling. Like I did that for 4 hours, and I ended up in tears. So I have to say that it does take a lot of grit and a certain type of personality to be able to be really successful at that. So I commend you for that. But so yeah, let's talk a little bit about then, let's look at it from the perspective of you as an investor then. When you go and you're looking at companies to invest in, what are some of those key things that you're looking for that indicates that it's a healthy idea or a healthy company?
There's no silver bullet, obviously. And of course, Silicon Valley, at least as it relates to technology, is the birthplace of really what makes the most success. And those things can become self-fulfilling because they're able to attract, when you get the backing of the right VCs, the right talent, and the right connections, and opening the right doors. But I think, it'll sound pretty generic. And I know I've looked at a little bit about your background, and I noticed you talked about passion in some of your work and research. And I really think that you're right on the money. I think, passion for what somebody wants to do, regardless of the industry, regardless of what the opportunity, if they really believe in it, they get up in the morning, they're excited about it, they're able to deal with the pitfalls much more easily, they're more engaged, they're working harder, they're talking about it all the time. They might bore people stiff at a cocktail party, but it's because they're so passionate about it. So, in my world, I love to be part of predicting the future. Some days I wonder why. It's hard to build early stage businesses. I tend to be very early, really from ideation right through to building it and selling the businesses. And I've been lucky enough to be involved from cradle to grave in a number of circumstances, many of which have worked out very well. Certainly got lots of scars on my back from a personal perspective, business perspective, everything you can imagine. But I always think of kind of outside success in kind of four themes. And the first one is the vision. I know it sounds, kind of a grandiose term, but I'm really saying that you can call it a mission statement, vision, you can call it whatever you want, but where somebody's really saying, I believe that either a cohort of society or the world or industries or whatever it may be are going to do something different in the future than they're doing something today. And so in technology, it's pretty engaging because it's usually, something very unique that's going to change as opposed to maybe more conventional business. But even if it's a conventional business, the point is having a vision of the future is something being done today. In the Valley, they talk about, what's the problem? What are you solving for? And that's fine. That's one way to say it. But sometimes vision isn't about a problem. The poster behind me, Future Vault's a business we've been building that I'm very, very excited about. And it's not so much about solving a problem. It's about predicting a way in which the way the world's going to do business, which is different. I tend to personally get engaged more about that than, the widget's made this way. And if you redesign the widget, it's going to be done this way. Those are great. People can build great businesses and have a great life. And you can back businesses like that. And it can be very exciting and fun and rewarding. I personally like as I say, here's how the world's going to be different. That's part one. And by the way, it's got to be right for you to hit the ball in the park. The second one is, I believe you need to attract a half a dozen. I use the words very purposely because half a dozen is a pretty vague term. What do you mean? Is that half a dozen? Is that six? But we all know sometimes it can mean 4 or 5. Sometimes it means 7 or 8. But a half a dozen A players. And the reason I choose the words that way is you can't get away with 2. You can't do it with 2 A players. It's just too thin. And you can't have 20. It might shock you, but there's just too many prima donnas. You need B+ players as well in your organization. You probably don't want a lot of C's. You definitely don't want to need a lot of D's, but you can't have all A's. So, and your half a dozen A players usually are really in disciplines, sales and marketing and finance and operations and product and kind of all the things we think about in business generally, and certainly when you're starting a new business. But the main theme is that those half a dozen A players have to share the vision. They come at it a little differently with their own backgrounds. They nuance it a little differently. And that's where you get some really neat alchemy and chemistry that can take place. But if they don't believe in that vision, you're going to be very tough. So to your point, the CEO can be there with a great vision. He's got 3 other people in the room. But if you sense that they don't really agree with that vision, that is usually a telltale sign to me that there may be some challenges on this. In the same time, you get half a dozen people show up and they're all singing from the same hymn book about that vision. That gets very, very exciting. The third one is what I call being slightly ahead of your time. This is actually, we could talk for hours about people who've had brilliant ideas and predicted the future, but if they are too early, it's usually a sad story. And you hear about, I knew a guy, he was talking about that 20 years ago. And I've fell victim to that several times myself. I've been too early because when you're passionate about something and when you really see the future for something, you think it's going to happen tomorrow. And yes, technology is moving so fast that the changes are happening quickly. You look at the pandemic, how quickly it made behavioral changes take place as an example. But things don't happen overnight. And certainly in geographies, things happen in New York and Los Angeles faster than they happen in Middle America, as an example, particularly as it relates to the adoption of technology. And so being slightly ahead of your time, to me, is that third ingredient. So vision, the half a dozen A players, and being slightly ahead of your time. If you're late, forget it. Like you can't catch up. So too early, it can be sad. You got to be able to hang around. And it's that notion of slightly ahead of your time. I believe that, you always talk about the proverbial hockey stick, and people make the joke that when you see a business plan, somebody shows up with their chart around expectations of revenue and profitability, and they call it a hockey stick because they typically go like this. I actually think they're real. They're real for people and they're real for businesses. What's really happening is in the blade of the stick, the individual is building their core competency, or the organization is building for that day in which the commercial world is ready for whatever they felt was the prediction of the future for a career or a business. And then it truly does look like an overnight success and the hockey stick takes off, but really without the blade, meaning being slightly ahead of your time, you didn't have an opportunity to be positioned that way. And the fourth ingredient is a little good old fashioned luck. I mean, of course you make your own luck, but some people are lucky and some are less lucky. So those are my kind of 4 overarching themes that I have stuck with forever. And I generally believe if you can assess those relative to an opportunity, you'll have a pretty good view of where you are in terms of the likelihood of that working out.
No, I like those. And I'd like to dig in a little bit about the timing. So let's talk about, when you're looking at the future and you're trying to project the way we're going to work or what the needs are going to be, how do you assess if you're, too far ahead of the curve? How do you test those ideas?
I think anybody who tells you that you can test that is probably not being all that realistic, would be my sense of it. I mean, what you often see, and certainly in tech speak or Silicon Valley speak, is this validated the thesis. Somebody else is doing this. And the old adage, which probably is supported by facts, that the first one often isn't the winner, and often it's the second player to a new category. But I'm not so sure I subscribe to that. That's too risky. If you really have an idea that is predicting the future is going to be done in a different way than today, I think you got to be in the game right away with that idea. And the key is to have cadence with respect to your hiring, cadence with respect to your use of cash, cadence with respect to your business planning, such that if you are too early, you don't run out of money or you don't run out of confidence. This business Future Vault, we thought, oh man, we got to move now. We have this whole vision of how everyone's going to have a personal life management digital vault. And you can say, wasn't that what Dropbox is? Well, there's a whole different theme we have and such that I'm not going to take you through it right now, but I want to just use it as the example that, our view is that within 5 years, everybody's going to have a digital vault likely delivered to them by a financial services organization. When we started, we felt it was right around the corner. We were evangelizing. So you'd be in front of a, chief product officer at a bank or a credit union or a money manager telling the story. And they'd all say, yeah, that's pretty interesting. I could see why delivering our monthly statements, year-end tax, and saying to the end clients, oh, if you'd like to store your personal financial information in our vault as well, how that's going to be sticky to the relationship, how that's a value proposition, how that's going to add value. And then they can permission accountants and lawyers and tax attorneys and all that kind of stuff. But what happened was, we started this 5 years ago, so it's a good example of this. The commercial world wasn't quite ready for it, but now the very same people that we talked to 2-3 years ago as evangelists are calling back saying, oh, we've got this in our roadmap. We remember you came to see us. Now we're ready. So the key is, and I've been in both circumstances, if you go out of the gate as if it's happening immediately, you can run out of runway. If you come into it saying, we're going to have this cadence, and when it becomes real, then we put the gas on, that's your ideal circumstance.
And how do you see the most effective way of kind of, I guess, introducing that discipline? Because I think, the cadence thing is really important because when you get all caught up in your idea, you think it's going to happen tomorrow. So you probably take risks financially. Like I'm just going to go ahead and bring on these 5 people and maybe you really don't have the support, the business to support that. So how do you introduce, checks and balances and discipline around that cadence?
Well, I would say in most cases, and I've done this, you'll make a mistake. We did something I'm very proud of that we created, and it was an example of being too early. Many years ago, I co-founded a business called Jump TV. And this was streaming live video, which today you go, okay, big deal. Well, it actually was a big deal in 2005 when we started the business, and we ended up being the technology backbone for 170 NCAA schools. So if you went to their website, it said powered by Jump TV. You could watch your kid, if you lived in a different city, wrestle, swim, et cetera, et cetera. And then we hit pay dirt when the NHL became our biggest customer, and then the NBA, and then the NFL all became very massive customers for us. And Morgan Stanley took us public, and I was the chairman and CEO, and it was a fun, really big fun journey and part of my background. We were too early. Listeners don't need to be technology experts to process the following stat I'm going to give you, because it'll be really telling for you. When we started, we were paying 65 cents a gigabyte to stream content. Now, if you watch a Netflix movie or a 2-hour soccer game, you'll consume about 2 gigabytes. When you say paying it, what do you mean? Well, you need to use content delivery networks, companies like Akamai, well-known big public company, to get that stream to the public so that it doesn't buffer and so that there's no latency and all these kind of things. Our business bet was that the cost of using a content delivery network would decline precipitously over time. So at the beginning, we were blowing our brains out. We were charging, if you were a parent of a kid at Notre Dame, which was one of our NCAA schools, you paid $10 a month for your subscription. Half went to the school, half went to Jump TV. Well, if you watched, 3 soccer games, we blew our brains out because it was costing us $1.30 every time you did it. But as time moved on, those costs came down, as we predicted, precipitously. And when we sold the business to Endeavor, which is a New York Stock Exchange listed company, in April 2018, we were paying under a penny per gigabyte. So that was a business thesis, but it hurt us because we were blowing our brains out in those first couple of years, and it wasn't happening as quickly as we would have liked. And if here we were streaming in 2005. Netflix doesn't start streaming until 2007. The iPhone isn't in the market commercially until 2007. So we were too early. So I give it as an example because we should have been. We sold it to public knowledge. We sold the company for $250 million US to Endeavor. We should have been Netflix. Not that we went after the consumer market like they did. And when we sold it, we were the largest live streaming company in the world, which I'm very proud of. And now Endeavor Streaming is the largest live streaming company. But it's a great example of, we had the vision, we had some fantastic people, but we were too early. And as a result, we didn't get the optimal, it's still a great result. We sold the company for real money, but we could have hit a home run in something where we were absolutely unequivocally predicting the future would be done differently than it had been done before.
Yeah, no, that's a great story. And I guess I'd be curious then, as a business owner, I'm always looking at, well, how is project management going to be different, which I find to be a very difficult question, right? Because it, in some ways, project management is a structured thing that it doesn't change too much. I mean, yeah, there's different methodologies, frameworks, different leadership, but what's going to revolutionize project management services, I haven't figured it out yet. But where I'm headed with that is when there are people who are out there trying to actively look at the future of work, how do you approach that, or how do you come across your great ideas? Like, is it that you're out there reading, certain things? I mean, how does that work?
It's first of all, I'm a terrible project manager, so I admire project managers. I mean, my project management's on the back of an envelope. At least I'm smart enough now that when I write stuff on an envelope, I'll take a photo of it on my iPhone so that when I've lost the envelope, I literally. And I just struggle on that front. But I can only imagine the technology that's going to come around, measuring it should take you 20 minutes to do this and 32 minutes to do that, and kind of stuff that you live and breathe. I love leading edge stuff. And whether it's streaming in video or in fintech, what we're doing right now with FutureVault, we built another fintech a few years ago called Symbility Solutions, which again we sold. That was to CoreLogic, which is a Nasdaq listed company, and we built a way in which to process property claims on a more efficient basis. Now, FutureVault was my idea. In the Jump TV example, a guy called me and pitched me, and I went, I love it, and I became chairman. In Symbility, one of my longest friends from high school, actually. Very, very smart guy, came to me with the idea, and I backed him. And I'm involved with a company called Giftogram, a very, very cool both for corporate gifting and e-commerce. I can send you, I don't need your address. That's really cool, Jana. I just need your cell phone number. I send a giftogram once a week. Once a week, somebody makes me money, I send them some steak knives. You have a good thing. We'll get Deanna to remind you that we're going to send you something after this. Be modest, Jana. And I get 2 thank yous because I send you a text. It says Scott Paterson sent you a giftogram, and you accept it or don't accept it, and then you choose where it gets delivered. Oh, I'm on vacation or wherever, at my house, my office, and I get 2 thank yous because you go, oh, that's kind of cool, thanks, Scott, but you don't know what it is yet. And then the retailer or wholesaler has this little cardboard box, a little bow on it, not overly expensive, but nice and professional, better than getting a brown box from Amazon, and you get it shipped to you the next day, and you open it up. And it's a very cool way. And that's got massive virality potential. And that business is growing very, very rapidly for us. That was my former personal CFO for my small family office. And he wanted to be an entrepreneur, and he came back to me with this idea. And so I backed him. So one of the things I work at is deal flow, making sure I am seeing ideas. You know, I'm in electric battery deals. I'm in graphene deals, you know, the components for electric batteries. I'm in NFT deals right now. I'm in carbon credit deals. I'm constantly trying to stay, not, you know, so that it's, you got to be careful because there's a lot of fluff whenever these things come to the market. But I'm trying to stay leading edge with respect to what's really happening. Like the whole crypto thing is fascinating. Future Vault has a whole crypto angle to what we plan on allowing individuals to monetize their personal information. We're not going to give you a free Future Vault. We're going to pay you. We're going to pay you tokens to open a Future Vault. And every document you upload, you get more tokens. And when you share material fields, say car insurance, your expiry date, more tokens. And the model making your car, more tokens. Who's the counterparty? Well, we hope it's the Geicos who sell car insurance. What do they buy? You can call it a token. What are they really going to buy? Just leads, customer acquisition tools. So taking advantage of new technologies, new thinking, especially the way the Gen Zs and the millennials are embracing the world with their phone and the way they think of fintech, but putting old-fashioned ideas onto it. Well, how do people sell car insurance best connect with that cohort? And so that's why it's really important. By the way, that cohort cares about the environment more so than any time any young generations ever cared about the environment. So tying in that to a certain percentage of those tokens will actually go to carbon related causes, et cetera. So kind of, and our vault allows you to store NFTs, for example. So if I'm not on top of what's happening with NFTs and carbon credits and crypto, then where am I going to be with Future Vault? I'm going to be with an old mentality of what a digital vault might look like, as opposed to what we're doing, which we think is absolutely leading edge, if not bleeding edge.
You'd mentioned quite a few different ventures that you've done and the disparity maybe across the industry. So talk to me a little bit about that diversification and, you know, what are you an expert in then that allows you to see winners despite not being in the industry, like that specific industry?
Well, it's a great question. And I'm most successful when I have an operating partner. So I don't think of myself as an operator. I do get deep into the weeds. I enjoy business development, back to the cold calling, and figuring out how partnerships can work and what influencers will add value to what we're doing and what the product actually looks like. But I'm most successful when I have a strong operating partner. And my part of the puzzle is, you know, financing, kind of putting the right board together, the right advisors, recruiting top executives, opening doors, using my Rolodex, my relationships, my experiences, and frankly, not making mistakes. I mean, something I wanted to mention earlier when you mentioned something and I forgot to do it. You know, I made a mistake on something recently that I know better. I don't mind making mistakes. I just don't want to make the same mistakes. Mm-hmm. And, you know, years ago with Jump TV, we went public, we raised a whole bunch of money, and we got this nice big fancy space and this big fancy office. Not crazy, but, you know, with a big couch. And then it didn't happen as quickly as we hoped. And then we're scrambling to get off the space. And then I let it happen again on a venture, which I backed. And the guys were seasoned people, but inexperienced around this aspect. And they went to get the bigger space. And we're, guys, you can't do that. And they said, well, you're the chairman and we're the CEO and we're the president and we've got to make decisions and we run the business and not you. And I really do believe if you bring on somebody, you've got to delegate and give them the responsibility and they've got to deliver. But there are examples like that where I just should have said, you know what, I'm sorry, I'm overruling you because it took longer. And then that company stuck with this albatross, 3 times more space than they need, a monthly bill they don't need. And I knew better. And that's when I get upset at myself. Not when I make mistakes, but only when I already know that's not a very smart move and let that happen.
Yeah, absolutely. So how do you, though, I guess, evaluate some of those ideas then that come across? I mean, obviously, you don't take every person who says, hey, here's my idea. Do you want to back me? So what are some of those things that you look for?
Well, this is where the background of investment banking, I think, is a real benefit that I have. And I also served as chairman of the Toronto Venture Exchange for a number of years and vice chairman of the Toronto Stock Exchange previously as well. So I not only had exposure to my personal deal flow investments and the brokerage firm that I built that we became #1 technology investment bank, but also got to see kind of the swath of everything else that came to the market for many, many years. And I still really work hard on making sure I have that deal flow. It's pretty easy to, I think, tell fairly quickly whether, a flake's easy to identify. And by that, I just mean somebody who's really over their skis and they might have a nice idea, but they don't understand the building blocks they need to put together. That's not tough. I try to be constructive in those circumstances if the person is genuine and kind of point out that maybe they might want to work for another company that's doing something similar to cut their teeth for a while before they go out and try to venture there. The other, set are where the people aren't necessarily naive, but, their sense of at least my view versus their view of how something might unfold from a commercial perspective is different, mostly based on experience and gut. And I don't have all the answers by any stretch. And I've backed a lot of people that I don't necessarily completely see the vision they do, but I think that they have the passion, that they've got a vision, that they've surrounded themselves with some good people. And to the kind of point you're making, they are more of a domain expert than I am in respect to what they're actually doing. And, the other piece, liquidity matters too. I don't really love the VC model, which is, you're going to put it in 10, 2 are going to be big winners, 4 will be okay, and 2 you write off. I think a lot of people are very quick to write things off, and I get it from a time management perspective. But it's not so much my own money, but when I solicit other people to invest with me, which I do all the time, they're not doing a lot of due diligence. So they're expecting me to do the due diligence, but more importantly, to stick with it. And a bit back to the very question you're asking, I'm one of those guys that would much, much better bet on the horse, meaning the jockey and the management team or even the person, than actually the vision and the technology. Because many, many times, and amongst the most successful companies around, there's a lot of pivots that take place. You need somebody that can pivot. They can pivot because all of a sudden, holy crap, carbon credits didn't matter 3 years ago, but now they do to this industry. Or NFTs didn't exist. How do they play a role in what you're doing? DocuSign wasn't ubiquitous 3 years ago. It is today. I mean, I'm making stuff up in real time, but these are examples of extraneous factors that the right management team can pivot in real time. And so that's what I'm looking for. And also somebody that's going to be able to attract other investors. Okay, if you attract me, can you bring other investors in? Because I don't want to be the only guy on the hook, and then I've got to decide, do I keep funding something because I was the first investor in it?
Oh, absolutely. Yeah. Well, then I'd also, I guess, love to hear from your perspective, what are the things that you see cause companies to fail? Like, what are those kind of key characteristics or missteps or whatever that, some of those businesses don't take off then? What are they missing?
Well, some of it is the timing. So it can be a great idea, but it's just the wrong time. I mean, if it's too late, forget it, but it's too early. I think we being, my family office and what we do day to day, we see a lot of stuff that we like the carbon stuff as an example. There's a lot of stuff out there that wouldn't surprise me at all is amazingly successful 5-10 years from now, but it just feels way too early. But I also think the thinness of an organization too. Now that's chicken and egg stuff, but that's a bit back to the passion. If you can be young, old, whatever you want, tends to be mostly younger people, partly, Jana, or largely because they haven't failed yet. And it's painful when you fail. And when you're older, it's not as fun and it's embarrassing. And it's, I find myself, I just joined the board of one of the crypto exchanges in Canada that just went public, a company called CoinSmart. Really, really great CEO, great team, doing really well, record results month after month, and a couple of great board members and other independent board members. And I'll kind of shout out to one of the guys who's a top executive at DraftKings. And he wrote this amazing detailed email to the board after management sent out some information for a recent meeting. And I looked at it and went, that was me. That was me with that detailed 6 pages, that energy. And I was so proud of him for doing it. But I also thought, ooh, that's not good. Like, I'm not doing that piece, sort of because I want the younger people to do it. But a little bit of it is I've got more energy than, anybody I know my age and play squash every day. And I've got kids, by the way, from 24 to 1.5 years old. So I got the whole thing covered and all that kind of stuff. So I think I have a lot of energy, but it's a slightly different thing I'm trying to communicate, that youthfulness, or when you're doing this for the first time, being asked to add value in that construct, you feel this innate desire to really add this energy and value that you can, that he did in this case. And so it's one of the things when you get older as an entrepreneur, you have to really do that, check that I just did, going, whoa, don't lose that, or you won't be able to add as much value. But it comes more naturally to younger people. But the other side of it is, you have to be able to attract people too. So if you're young with that energy, you can't just say, well, I haven't done it yet, so I can't attract people. No, you need to go on LinkedIn and find the people that have your vision, or I'm making up LinkedIn, whatever. You have to take the steps you need to, so you can show up with a little bit of depth. That might not be 6 people, it might be 2 or 3, but some other bodies that are credible around saying, we also believe in this vision. And usually we're not taking market rates, but we're taking equity as a big chunk of our remuneration too. That to me is a big piece of when somebody's pitching me. That means a lot to me when I hear that.
Absolutely. Well, Scott, this has actually been a really exciting conversation. I'd love to hear what your kind of 3 tips are around being, either running a successful business or being successful in investing in business. What are your thoughts?
Well, the quick one I'd say on starting a business or joining a business as a board member or an executive, or even time to refresh. You've been at it and you say, let's go and do an offsite. I would encourage all entrepreneurs and their management teams to put a list of all their constituents down. And that's not all that difficult. And that can be, from, whether, depending on whether you're B2B2C or B2C, whatever it may be, but it could be end client, it could be, channel partners, could be government regulatory bodies, obviously employees, shareholders, the press. You'll come up with about 10 constituents if you really get down to it. Your landlord could be a constituent. But the real thing I'm suggesting is force yourself to rank them in their order of priority. So I'll give you an example. When we built the brokerage firm, Yorkton Securities, that I built many years ago, we did this exercise, and we were primarily an investment banking shop. So technology entrepreneurs would come to us and we would raise the money, either take them public or private, whatever it may be. And so we said, well, our constituents are the issuer, meaning the company CEOs, the guys that were hiring us. We're going to pay you 7% to raise us $10 million or 20 or 100 or whatever the mandate was. But our constituents were the money managers, the buy-side decision makers, and private clients. And we made the decision, and I'm really proud of this, we made the decision that the buy-side money manager, so picture a mutual fund manager or a pension fund manager or a family office manager, they were at the margin the most important constituent we had. And that the issuer decision maker, the company decision maker, they were at the margin slightly behind. Say, whoa, didn't you tell me that the companies hire you? They're the ones who are engaging you as an investment bank, and yet you say they're not as important a constituent to your business? So that in itself should represent a conflict. But the reason I say that is the company wants $10 a share when they're doing their IPO. But the buyers are feeling more comfortable at $9. And you know that if it's done at $9, it's probably going to trade at $9.50. But if you force them to do it 10, it's probably going to trade at $9.50. And you know that if a company opens up slightly at the beginning, many years it can live with a better outcome than if it opens down at the beginning. And so we made that decision, and we openly, transparently articulated that to the companies. You are not our most important decision constituent, even though you're the one paying us the money. But what it does is, if you take this exercise, every decision you make, are we getting a photocopier? Where is our space? Are we hiring another salesperson? Are we hiring another product person? What are we doing on the PR front? What are we doing in thought leadership? What are we doing on influencers? You name the decisions business make all day long. You then map it against the relevancy to the constituents. And it'll be really interesting around what happens. You go, oh, that actually only impacts the guys down here, these constituents, not so much up here. So that would be, a big piece of advice that's been really helpful to me over the years in helping businesses, ones that I've either been driving myself or I'm an investor in, or giving advice to others.
No, it's great. Well, Scott, if people wanted to learn more about what you do or follow your insights, where's the best way to connect?
Well, probably we're in the social media business, but I'm kind of half in it in reality. Although my kids are, I watch what they do very closely to try to make investment decisions. But I'm happy to have anybody be in touch with us. We love connecting with people and try to add value. I suppose my email address is the easy one, Jan. It's S Paterson, Paterson with one T. Paterson can be spelled with the one T, or the Scottish, they say, versus the Irish with two, because they said the Scottish were so cheap they wanted to say that. Who knows if that's true. So S Paterson at patersonpartners.com. We probably should have a better contact thing than that, but we'd be delighted to hear from anybody, and appreciate you entertaining some of my thoughts for a few minutes.
Yeah, thank you so much for being a guest today, Scott. And to our audience, until next time, keep your companies healthy.